Good evening, everybody. Here we go again. It is time for evening number 3 of P7 revision. We've had a few days off, haven't we? I'm trying to remember when our last one was. It was last week, wasn't it? A whole week, 2 Friday nights in a row. Hi, Philsy. So it's time for class number 3. A quick reminder, given we've had a 1-week break. My voice might sound clear, but trust me, I am still coughing away. But yeah, the voice is, no, it's still there. So, oh no, don't worry, I'll survive. Could be worse. So what have we done so far? We've reached the halfway point. We have done ethics. We have done practice management. We have looked at some big question ones. So we've been looking at risk. And I think we've looked at some risk of material misstatement. We've looked at some business risk as well. And within those questions, we've ended up doing some matters, procedures type of stuff as well. So we've opened up that part to our revision as well. So we're doing really good. We've got one more big, nasty question, number 1, to do, which is where we will kick off tonight. And one of the reasons we need to do this next question, it's again risk, of course, as you might expect, but it's got groups in it. And often question number 1 is about a group of companies and all the related issues that groups then create. So that's what we're going to be starting off with. We're going to be doing a bit more matters and evidence as well, so another night with lots of accounting stuff in it, I'm afraid. And if time allows, at the end of the exercise tonight, we'll be looking at some audit reports and a question on that as well. I might drop 1 or 2 things into the gaps between the questions just to keep us all fresh. But let's get going with a little reminder about groups. Let's do that. So, auditing a group. Now, in terms of auditing groups, most of the audit is just like auditing a regular company. In fact, if you think about it, what is auditing a group? If there's a group of companies, you've got the consolidated financial statements, of course, where they're all sort of added together. But you've also got the individual financial statements of each of the companies within the group. So if you think about it, all that really happens is we audit each set of individual financial statements, and then we audit the process of consolidating them. So it's just like auditing a company, except there's several of them, but there's this consolidation process at the end that we need to look at as well. As you might remember from the teaching phase, if you've got a group of companies and it's the same structure as last year's group, then frankly it's not that exciting. The far more interesting thing, and this is the common exam question, is how things change when there has been an acquisition during the year. So what I'm going to do is just go through with you a reminder of the things that you should be looking out for within a question. And then we're going to go look at a question and we're going to see what we can find using this list. So what sort of things should we be looking out for then? Firstly, the acquisition itself. As auditors, we've got to try to establish, is it a subsidiary, which of course involves control? Is it a joint venture? Is it an associate? Which is all about significant influence, or is it simply a trade investment? So there's one thing that the auditors need to do. Of course, part of this is based on the percentage shareholding that your client has achieved. We'd normally assume that if it's above 50%, it's a subsidiary. If it's 50-50, joint venture. If it's 20% and up, it's an associate. And if it's anything less than that, it's probably a trade investment. But it's not just about the shareholdings. Shareholdings can get you control, but there are other ways of controlling companies as well. If you've got a company which is in great financial difficulty, if you lend them money, you may have quite a lot of control, even if you don't own any shares at all. If I was lending you money and you were in trouble, I'd probably insist on 2 of my friends sitting on your board, so I know that my loan is being looked after. If I have people on a board, I get control through that as well. It doesn't just have to be shares. So there's one of the things I'd be looking at. I would need to take a look at the date of acquisition. That, of course, will have an impact on things like the calculation of goodwill, the split of pre- and post-acquisition reserves. Talking of goodwill, I'd need to audit that. 2 things to look at with the audit of goodwill. There's the initial recognition because it's been bought during the year, and that, of course, is the fair value of the consideration paid minus the fair value of the net assets acquired. But then also, by the time we get to the client's year end, there's the issue, has the goodwill already suffered any impairment? If they bought it 2 days before the year end, they'd be fairly unlucky if it's impaired already, although it does happen. But if they bought it a significant amount of time before the year end, things may have changed and it might have started losing some value. We've got to look at the subsidiary, if it is a subsidiary, and see, is it a different year end? And we've got to look out for different accounting policies. Now maybe at that point you start to think, but what if it's a subsidiary that is overseas? Because if it's overseas, I will be looking out for, is it in a foreign currency? If it is, it would have to be retranslated, of course. And maybe if it's overseas, they're not following different accounting policies, they might be following different accounting standards. Now, some things you can flush out with simple consolidation adjustments. If a year end is only different by a month or 2, you can probably tweak the accounts a bit so that they can be consolidated. If there's 1 or 2 accounting policies that are different, you can probably use consolidation adjustments. But if you've got a subsidiary whose year end is more than 3 months different to the group, if you've got a subsidiary that's overseas and following totally different accounting standards, you simply can't take the accounts and fiddle with them. You're going to have to throw the accounts away and get a second set of accounts done for consolidation purposes, because they'll be so different, it's probably easier to start again. And then there's also the thorny question of who will audit the new sub. Again, I'm assuming it's a subsidiary for this purpose. Who is going to audit this company? If it's us, well, we can't just get on and start auditing it. If it's being offered to us as a new client, we will have to go through all the usual pre-appointment procedures. I won't write them down here. We'll be seeing them during the final class, actually. When is the final class? Next week? Wednesday, I think. But you know the sort of stuff. Of course I'll audit it, as long as the fee's sensible. I've got the staff. I've got the time. I'm competent to audit the client. There are no conflicts of interest with other clients. Integrity of client. You know, C of I, conflict of interest. I of C, integrity of client. I'd have to talk to the outgoing auditors, professional clearance, check whether the preconditions for an audit are in place, and all the usual stuff. And then once I'm appointed, I will need to document their controls, build up my understanding of the company, and all of that is going to take some time. I can't just go and start auditing tomorrow morning. If, on the other hand, it's going to be another firm doing it, well, if another firm is doing it, I need to check that this firm are reliable. Because if I'm reporting on the consolidated financial statements, this subsidiary's figures are in the consolidated figures, which means I'm now reporting on figures, some of which I have not checked. Another firm has done it, which means I need to assess, is this firm qualified, experienced, and independent of their client, which they probably are, because auditors generally are, but if this audit firm are overseas, bear in mind that they might be following a different code of ethics. They might not need to have an audit qualification. They might not be independent of the client. There might not be those rules in that country. So if they're overseas, there might be a different ethical code. Hey, they might even be following different audit standards. And whereas in the UK, audit firms' work is being monitored by outside regulatory bodies, giving us some assurance that auditors are doing what they should be. In many countries, no such monitoring exists. So we need to check all of those things out to see just how reliable this other audit firm are likely to be. Now, there are other issues as well, but it's revision. I shouldn't need to go through every single one of them. Just point you in the right direction of the sort of things that you should be considering and looking out for. Right, time for our first question of the night. I think I asked you to have a little look at this one if you had the time at the end of the previous class. So we are going to look at this question here, which, as you will see, is from the June 2012 exam. So a couple of years ago, fairly recent. So June 12, it's question number 1. Let's go down to the end of it. Now, there is actually a part B to this question, worth 6 marks. And just before we look at part A, I just want to check with something with you, or go over something with you. We're not going to do part B. It's on ethics. We've done stacks of ethics already. But just bear this thought in mind. Part A of this question is worth 31 marks. And to earn those 31 marks, you have got a very big story, almost 2 pages long, to get through. So almost 2 pages to earn 31 marks. If you look at part B, you have got a very short scenario and 6 marks available. In terms of efficiency when you're in the exam centre, if you only have to read 5 or 6 lines and there's 6 marks attached to it, I'm tempted to suggest that you'll earn marks a lot more quickly on Part B than you will on Part A, where you've got to get through a lot of material before you know what you want to write. So given how short this is, I'd be tempted, if question 1 looks like this, and it frequently does by the way, to go find what Part B says, because probably you can plan most of your answer to Part B without even reading Part A. It's generally a standalone part of the question. She does this on a fairly frequent basis. The end of the question often has things where you can get marks very, very quickly compared with the beginning. So at the very least, at the start of the exam, when you're planning answers, make sure you've planned the answer to Part B before you go into Part A in detail, because I think you'll find that you'll plan the answer to this, realise how easy it is, and it really is easy, Part B of this question, and that way you won't overrun on Part A because you know you've got the nice easy Part B coming up and you'll want to make sure you spend time on it. But we're not going to do Part B. Oh no, we're going into Part A. 31 marks. Now this is exactly what will happen to you on December the 1st. So in what, 3.5 weeks time, question 1 will have 31 marks of content probably, because the other 4 marks, because it's worth 35 these days of course, will be the professional marks probably. So 31 is exactly the sort of thing we should be practicing. It says, respond to the email from the partner. So off we go. Where's the box with the email in? There it is. You have received an email from Joe Dorr, the audit engagement partner. Hello, Joe Dorr. I have just been to a meeting with Steve Eagle, the finance director of the CS Group. We were discussing recent events which will have a bearing on the forthcoming audit, and my notes are attached. One of the issues discussed is the change in group structure due to the acquisition of Canary earlier this year. Our firm has been appointed as auditor of Canary. Right, so there's no other firm, this will be us, which has a year ending 30th June 2012. I wonder what the group's year end is. We'll find out in a minute. And the terms of the engagement have been agreed. Notice our firm has been appointed. So there's no need to worry about professional clearance, preconditions for an audit, are there threats to objectivity, etc., etc., because all of those things would have been considered before you accepted appointment. So all we're going to worry about is what we have to do after we've been accepted, or we have accepted. We need to start planning the audits of the 3 components of the group and of the consolidated financial statement. So this group is made up of 3 companies, and then you've got the consolidated accounts as well. So 4 sets of accounts that we will be auditing. The question then says, identify and explain the implications of the acquisition of Canary for the audit planning of the individual and consolidated financial statements of the CS Group. So it doesn't just say what are the implications, it specifically says how will this impact on the planning of the consolidated financial statement audit and also of the 3 individual companies. Okay? The second question, and sorry, that is worth 8 marks. It says identify and explain, and from my experience, she will typically offer half a mark for identifying and up to a mark for the quality of the explanation. So you could say you're looking for about 5 or 6 issues rather than the full 8, but we'll try and aim for 8. Part 2. Evaluate The risks of material misstatement. So the moment we see that, we should be thinking risks of material misstatement. Therefore, we will be thinking which accounting areas are affected by what we read. We will think, why do we think they might get it wrong? And we will think, are they likely to get it over or understated, or if it's disclosures, under or over disclosed? To be considered in the audit planning of the individual and consolidated financial statements. So again, quite a tough question, this one, because we've got to think about what we read in the story, and does it impact the consolidated accounts? Does it impact individual companies in the group, and if so, which one or which ones? Of course, most things that impact on one of the companies will get added up into the consolidation, won't it? But some things will not. Because if you've got intercompany transactions, those will be in two of the companies in the group, but they'll cancel out at group level. You could have one company doing something with another in the group, related party transactions, in their accounts, but they cancel out at group level, so no related party effect. So we can have some things that affect the individual accounts, but it won't be in the group. On the other hand, goodwill goes in the consolidated accounts, not in the individual accounts. But then on the other hand, goodwill is the fair value of the consideration minus the fair value of the net assets acquired. Whereas in the individual accounts, you'll just have cost of investment in whichever company bought the acquisition. Confused yet? This is a tough question. It's not just testing your accounting knowledge, it's testing your accounting knowledge and which accounts are going to be impacted. And just to make this question even more fun, it's worth 18 marks. Now generally, any risk question is probably 1.5 if you explain it well for each risk. But with 18 marks, a sensible tactic is probably to look for 18 separate reasons why they might get their accounts wrong. And let's face it, that's a lot of risks and a lot of accounting to explain. Right, so part one, we know the sort of things we're looking for. Bit disappointed with part one that we're the auditors. I like it when there's another audit firm because there's more to say. In part two, our accounting knowledge is going to be tested quite a lot. And then in part three, what does that say? It says recommend the principal audit procedures. Well, whenever we do audit procedures, there are 3 tactics. We can think A, E, I, O, U and think about the 5 basic types of audit tests that we do. We can think DA 3 and think about evidence, documents, assets, directors, etc. But I've also suggested to you that when you get one of these questions, what procedures would you carry out? If there's any sort of detail in the story, test the story. And I find that if your accounting knowledge is a little bit weak, testing the facts in the story will often get you marks because you're testing what the question says without actually necessarily understanding why you have to check that that fact is true. So if your accounting knowledge is weak, I think that is the tactic you might want to follow. It says the principal audit procedures in respect of the goodwill initially recognized, which means don't test for year-end impairment, because that's not initial recognition, that's year-end assessment. So all we're going to be testing is the fair value of the consideration minus the fair value of the net assets acquired. That one is worth 5, which means we are looking for 5 audit tests. Right, lots to do. One more thing worth remembering. We haven't seen what the dates in this question are yet, but please don't forget that in a planning question, when it asks you for audit procedures, you are not going to do these audit procedures today, because typically we plan audits before the year end. When we actually do the audit work will be after the year end. And sometimes that works to our advantage. Whether it will work to our advantage here, I don't know. But if we do audit work at some point in the future, other things will have happened between today and when we do those tests. And those other things that happen could be rather important. Okay, so we've got 3 things to do. Great big story. And I'm looking at those 3 things, and I don't know what the implications regarding the acquisition are really going to be yet until I've read the story and seen what's going on. I can't really tell the risks of material misstatement till I've read the story and I can see what's going on. I can suggest some audit procedures for the initial recognition of goodwill. So I am going to start my answer to part 3 first. Now, I know I said test the story, and that's exactly what we'll do. But if goodwill initial recognition is the fair value of the consideration minus the fair value of the net assets acquired, well, when companies acquire other companies, part of the cost is normally some cash straight away. So for any cash now, surely I can inspect the cash book and bank statements to verify, notice, explain everything, the amount. And the only way that that won't get me a mark is if it says in the question, there is no cash paid up front, it's all being paid in the future, which doesn't happen very often, to be honest. And I'm also thinking that when companies buy things, there's normally some paperwork, documents, you know, DADA 3 documents. And if I'm buying another company, I'd rather assume there's a great big sale agreement, some sort of legal contract. So as auditor, I should inspect the purchase agreement to verify control has passed to my client and to verify the terms of the acquisition. This is worth 5 marks. I can already get 2 because I'd do those for anything. Now those both focus on the consideration. We've also got to assess the fair value of the net assets that have been acquired. But as we know from the non-audit part of this course, typically if companies are buying other companies, they will get some due diligence done. And if they get due diligence done, I would inspect the report of the due diligence because that is giving me evidence as to the fair value of the net assets that were assessed at the time of the purchase. Now, whether I would just rely on the due diligence report is a bit questionable, but the fact is that is definitely a procedure and definitely going to get me some evidence. And if this is worth 5, I've just passed it. So I can pass part 3 without reading the story at all. In fact, I'll get 5 out of 5 because I can think of other tests too. But for safety, I'd now wait and go read the story, because I'm rather hoping that the consideration in this acquisition is not just cash. If it's shares, I can think of another test. If there's deferred consideration, another test. If there's contingent consideration, at least 2 other tests. So there's my start to 3. Yes, I know there is, but my point is I'm getting these without reading the story. You've read the story and you know there's contingent. I've read the story in the past and I know there's contingent. But on exam day, just by reading the requirement, I can pass one of the 3 things in this question. That's the point I'm getting at. And if you can get quick marks without reading all the detail, get the quick marks. So we'll come back to part 3 in a little while. We'll leave a bit of space. And let's go on to the next page of my answer. And let's start looking at parts 1 and 2. Clearly, given the 26 marks that 1 and 2 add up to, there's a lot of stuff in this story. So what I propose we do is, to help us plan our answer, let's have a 2-column answer plan. Part 1 is all about, let's just get this right, it's always a good idea to make sure we remember what the question was asking. Implications of the acquisition for the audit planning. So, implics of acquisition. And then 2 is the risks of material misstatement. Now please note, this is not how I would lay the answer out when I write it in full, but when I go through the story, I want to be finding issues for both 1 and 2 as I go. We did another question, the first risk of material misstatement question we did, which was really nicely laid out, because the story had issue 1, issue 2, then it had some quality control issues, issue 3 in effect, and everything was nicely in order. Unfortunately, more often she does it like this question, and you've got to go and find the issues from within the story. They might not fall out issue 1 first, then issue 2. They might all be mixed up. And we simply don't have time to read the question twice. So let's read it once and drop our thoughts in here. Just a reminder, we're looking for about 8 marks there and about 18 marks there. And don't be afraid of putting the same point in both columns. If it can fit in both, it goes in both. Okay, so let's go read the story then. If I can find the question, there it is. Right, here we go. So don't forget, in terms of group and acquisition issues, you know the sort of stuff we're looking for. I went through it earlier on. Let's go see what we can find. You are a manager in Magpie & Co, responsible for the audit of the CS Group. An extract from the permanent audit file describing the history and operations is shown below. So we're thinking impact of acquisition, risks of material misstatement. Crowe, incorporated 100 years ago, founded by Joseph Crowe, pottery making. Products quickly grew popular, products retained their popularity. Sounds like Crowe is a fairly safe company doing fairly well. 10 years ago, Crowe made its first acquisition, purchasing 100% of Starling. Both companies benefited, strong brand name, everything's going brilliantly. So the first couple of paragraphs seem to just be telling me that this is an existing group They're doing fine, they make pottery, it all seems nice and lovely. Crowe and Starling have a financial year ending the 31st of July. Notice it says ending, not ended, because this question came up in June 2012. The year end has not happened yet. Your firm has audited both companies for several years. Hang on though. Different year ends is something we're meant to look for, and there it is. So Canary, the new acquisition, is out by 1 month. Different year end. So we have something we can put in our answer. Implications of acquisition. Different year end. Canary is 1 month before the group. Why does that have an impact? Well, it means a consolidation adjustment will be needed to turn Canary's June 30 accounts into July 31st accounts. And that's a bit annoying. It's only a 1 month adjustment, so we need to strip out the first month of their year and add in the results for July 2012. And the reason it's annoying is this. That month that we want to add in, July 2012, is after Canary's year end, which means when we audit Canary this year, we're going to have to audit 13 months. You'll have to audit the 12 months in their accounting year up till the end of June to audit their accounts, because we're their auditor, don't forget. But then we'll have to audit what happens in July, because that month's results need to be added into their accounts. So we will need to plan the time and staff to audit 13 months of Canary. And I suppose you could argue that if you normally audit 12 months and now you're auditing 13, that's an extra 1/12 of time and effort. 8.3%, so it all mounts up. That will impact on the audit. Does that point also create a risk of misstatement? Yes. If you've got different year ends, any consolidation adjustment is a potential risk of misstatement. So, if the adjustment to change Canary's financial statements from June year end to July is complicated, it might go wrong. And that is a risk of material misstatement. Okay, we are up and running, different year ends. Back we go to the question. Well, we've been through what's in the box, so we can come down here now. Right, here we go, attachment. The most significant event for the group this year was the acquisition of Canary, which took place on the 1st of February. Well, the group year end is the 31st of July. February, March, April, May, June, July, so this has happened 6 months through the group year. We have got a mid-year acquisition. Back we go to the answer. Is that an implication for the planning of the audit? Yes, because if there is a mid-year acquisition, we will need time and staff to ensure that the split of pre and post acquisition profits is done, Does a mid-year acquisition create more risk of the numbers going wrong? Well, if you've sat the P2 exam, you know the answer, because when you tried to do a mid-year acquisition, it always went wrong, didn't it? If they buy it on the first day of the year, it makes life so much easier. So the issue here, the risk, is the wrong allocation of results before and after the acquisition. The fact that the year's results have got to be split. Right, well, we're starting to make some progress, but 18 marks worth of risks, still a lot to do. Back to the story we go. Crowe purchased all of Canary's equity shares for cash consideration, see, I told you there'd be some of that, of 125 million, and further contingent consideration of 30 million will be paid on the 3rd anniversary. Fantastic, we've got contingent consideration. Which means, back to my answer I go. And now I'm going to go up to part 3, because I want to test the contingent consideration. Contingent consideration should be in at the present value, because don't forget it's in the future, so the present value of the amount multiplied by the percentage likelihood that the amount gets paid. So in fact, I think I might need a little more information here, because maybe it mentions discount rates in the story, and maybe it talks about what the consideration is contingent on. So before I write this, let's go back. 30 million, 3rd anniversary, if the group's revenue grows by at least 8% per annum. Good. So back we go to the answer. 2, I'm going to put my explanation of why at the beginning of this one. 2, check present value of the contingent consideration estimate a discount rate for client. Now, how do you actually do that? Well, by using their risk-adjusted weighted average cost of capital. And then I can compare my estimate of what they should have done with what they've done. But I'll come back to that point in a minute, because I just want to read the rest of the detail in the story before I say anything else. So back to the question we go. Crowe engaged an external provider to perform due diligence. See, told you there'd be due diligence. And I'm delighted to see that they've got someone external to do it, because that gives me another test for my goodwill. Come back to that shortly. Fair value is estimated to be 110. Goodwill has been calculated as follows. Cash consideration 125, contingent 30, less fair value 110. I thought the contingent consideration was meant to be the present value of the amount multiplied by the percentage chance it gets paid. And what's making me nervous is that number there, because it said in the question just above here that another 30 million is due to be paid on the 3rd anniversary. Well, if that's the cash that's going to be paid, they've not discounted, and they've assumed a 100% likelihood it will be paid. because it still says 30. Whoops. Right. So that is going to affect a couple of things in my answer. It's going to affect the audit tests I'm doing on goodwill, and it's also going to affect the risk of misstatement, because that goodwill is misstated. It's overstated. It has to be. So back we go to the answer. So to check the present value, estimate a discount rate for the client using their risk-adjusted WACC to help identify how overstated the goodwill is, because they have not discounted. You see, normally I'd have said compare my discount rate with the one they've used, but I can see the one they've used. They've not discounted at all. Now they are suggesting in that calculation that this amount will definitely be paid. In other words, revenue will definitely grow by 8% per annum. I should assess that to assess the likelihood of 8% per annum revenue growth. What am I going to do? Well, presumably I'll look at the forecasts for the company, but don't forget this acquisition was on the 1st of February. The group's year end is the end of July, which means I'll probably be doing my audit work in August or September, which is a good 8 months or so since they bought the company. So I would inspect revenue growth so far in the 7 or 8 months, because by the time you do the audit work, that's what it will be, since acquisition, to see if group is on track to average this growth. See how far they've grown it so far. But we're only a few months into this and it needs to be 3 years of solid growth, so I would also inspect company forecasts to identify if this growth is expected to continue reviewing the assumptions of the forecasts for reasonableness, because forecasts are estimates and are therefore always a bit dangerous. Right, how are we doing with the procedures? 1, 2, 3, 4, 5, 6. Done. Yay. I could go further though, because I've inspected a due diligence report because I assumed there would be one. It also tells me that the due diligence was done by an external person, so I can't just look at the report. I've got to decide if that report is reliable. So I would also, if I had time, throw into the answer, identify the person who did the due diligence and verify, oh dear, sorry, verify their professional qualifications assess their experience of doing due diligence reviews. Oh dear, sorry, my hands at this stage of term are incapable of writing neatly. And their independence. From our client. Now, I have gone beyond 5 marks, well beyond 5 marks now, so we must stop. But that part of the answer, as you can see, I am trying to demonstrate not just what the points are, but how to explain them. And I think, yeah, for that part of the answer, is what I would hand in. That is a full answer. It is not a plan. For the rest of the answer, to get some speed and to get through the points more quickly, I am going to be going with a plan. So, implications of acquisition, different year end, mid-year acquisition. The goodwill is complicated, especially due to the contingent consideration. Therefore, we will need someone senior to use their judgment to audit it. Is there a risk of material misstatement? Well, I told you earlier on that when we're looking at acquisitions, goodwill has 2 separate issues. In the third part of the question, we were only required to do audit tests on initial recognition, but this was bought 6 months before the group year end, and after 6 months there is a risk it might have been impaired. So there's 2 separate things. Risk, overstatement of goodwill. And there are 2 reasons why I think it might be overstated. One reason is, I know it's overstated, their failure to discount the contingent consideration. Because you are required to, under IFRS 3. And secondly, there is a risk of overstatement if it's impaired as at the year end. Now, I've not seen any evidence yet that this acquisition, the value of it might have been falling. I've seen no evidence yet. Maybe I won't. But the simple fact is that with any intangible asset there's a risk of impairment, and with goodwill the rules are there must always be an impairment review at each year end. Don't forget. And the reason why they have to do those impairment reviews is because goodwill is always at risk of having lost value. So we're starting to build up a little bit of misstatement risk now, which is good. But we're still a long way short of the 18 or so that we suspect we might need. So back to the story we go. Let's find ourselves some more. To help finance the acquisition, Crowe issued loan stock at par on the 31st of January. So halfway through the year, they've issued loan stock. Well, loan stock means they're borrowing money, but instead of going to a bank, they're issuing their own loans and inviting people to lend them money. Now, maybe banks will lend them money, maybe you or I might lend them money. It almost makes loans a bit like shares. You can choose to choose to lend them as much as you like, instead of them going to one bank and trying to borrow the whole lot in one go. Well, loans are a financial liability, and that means I am thinking IFRS 7 and 9. 9 is the accounting, the valuation, and 7 are the disclosures, of which there are lots. Now I can already talk about the risk of getting the disclosures wrong for 7, but also IFRS 9 is about valuation, and that means I need to start thinking about interest and stuff like that. So let's just read a bit more. Raising cash of 100 million. The loan has a 5-year term, be repaid at a premium of 20 million. 5% interest payable annually in arrears. Right, so we've got the regular 5% interest. If that was taken out on the 31st of January, the first $5 million interest payment is due on the 31st of January next year, which means at the year end, 6 months of interest, so let's call it 2.5 million, will have accrued. There is a risk, they don't accrue for it. The other risk is that 20 million, repayable at the end of the term. Well, you can't just forget about that 20 million for 5 years. That, in effect, is additional interest. And over the 5 years, it should gradually be accounted for, so that after 5 years, the loan balance is not 100, it's 120, and then it all gets repaid. Loans are fabulous for risks. Now notice, we're now beyond the acquisition, and I don't have enough in there, so I'll be going back to that one in a little while. But risks of misstatement, the loan. Risks. Under disclosure, because IFRS 7 requires loads of stuff to be disclosed. Things like the interest rate, what else is it? The repayment schedule, etc., etc. The effect it has on the risk profile of the company, all sorts of stuff. There's also the risk that they have under-accrued for the 6 months interest at the year end. And there's a third risk, and yes, before you ask, all of these are separate risks. So suddenly we're heading more quickly towards the 18 or so we might need. Hopefully we'll explain these well enough to get 1.5 marks each, but we'll keep pushing for more. And that is, they might fail to spread the 20 million premium over all 5 years. And that would mean, again, understated finance charge and understated loan, because what they should be doing is gradually accruing for that 20 million and building it into the loan balance on the statement of financial position. So 3 at least separate issues for the loan. 1, 2, 3, 4, 5, 6, 7. Okay, we're heading in the right direction. Back to the question we go. Canary manufactures pottery, figurines and ornaments. Sounds like pretty much the same stuff the group does. Good strategic fit, products are luxury items, its acquisition will enable the group to diversify into a different market. All very exciting stuff. Approximately 30% of its sales are made online. Hooray! Because online sales are a risk of material misstatement. So back we go to the answer. So now we're looking at revenue recognition, which for the time being is IAS 18. Why is this a problem? Well, when you buy things online, you typically have to put your card details in and pay for the whole thing there and then. And many companies have their websites hooked up to their accounting systems, meaning as you buy it, it's likely to record the sale there and then. The problem with that is that normally in accounting we say the sale happens when the goods move. Well, when you buy something on the internet, You don't immediately have the delivery happen. There's normally a delay. It might only be a few days, but that could have an impact at the year end on cut-off. So there is a risk that sales are recorded too early and are therefore overstated, i.e. before delivery. The other risk with online sales is you're never 100% sure that every sale that goes through the website has actually found its way into the accounts. So there's an opposite risk of understated sales if the website is not efficient at recording all of them. Fantastic. Back to the question we go. It is hoped that online sales can soon be introduced for the rest of the group's products. Difficult one to spot this, but one of the things in part one of this question that should be on my list of things to look out for is different accounting policies. Now, as I said, difficult point to spot this, but surely Canary must have an accounting policy for their online sales, and the group will have no accounting policy for that because the group does not, it would seem, sell online. So we've got different accounting policies here. Not one of the biggest issues in reality, but Canary, online sales, their accounting policy needs to be brought in line with the group that has no online sales, and that might need a consolidation adjustment. And every consolidation adjustment is another thing that the auditors need to spend time and staff checking. And it's also going to create another risk of material misstatement. Because at the moment, the group financial statements, the consolidated accounts, will not be disclosing a policy for revenue online sales because they've never had online sales. So there is a risk of under-disclosure of the policy re online sales. This is a tough question, don't get me wrong, but let's go back and keep going. Canary has only ever operated as a single company, so this is the first year that it is part of a group of companies. Is that something that will impact on my planning? Yes, because you've got to talk to each component of the group and make sure each subsidiary knows the information that has to be supplied to allow the consolidation to happen. You know, intercompany transactions, related party transactions, any adjustments that be needed, etc. And these guys aren't going to know what those issues are because they've never been involved in a group accounts before. Now, of course, there'll be qualified accountants there, but if they passed their exams 15, 20 years ago and they've never actually been involved in a real group, I mean, do you really think they're going to remember what all the group accounting issues are? Probably not. So in my answer, I would say we need to spend time at planning stage explaining the group accounting and audit issues to Canary's management. As it appears, they have no experience. And you could argue, although this is being a little bit cheeky, that we can then go and put the same point in this column, risks of material misstatement, because Canary, any consolidation adjustments from them might be wrong because of management inexperience in group accounting issues, and that would impact not Canary's accounts, because they'll get their own accounts right, the consolidated financial statements. Whew. Right, still stuff to read. The group has performed well this year, forecast consolidated revenue, etc. We've got some numbers, which means in my actual answer, all of these risks I'm highlighting, I could decide to calculate the materiality of those risks. I know how much contingent consideration there is. I can compare that with the total assets, for example, of the company. So we could calculate materiality all the way through. It then gives me these numbers. I suppose I ought to look at them, otherwise why is it telling me these numbers? It says Canary's results have been included from the 1st of February, so the date of acquisition, and I can see that Canary contributes 16 million of revenue out of 135 and 2 million of profit out of 8.5. Remember, this is only 6 months of Canary, which means in profit terms, if they're making 2 million in 6 months, 4 million in a full year, that's almost half this company's or this group's profits. Revenue, 16 million in half a year, let's assume about 30 for a full year. That's over 20% of the group's revenue, which tells me impact on audit, Canary is a material percentage of the group's revenue and profits, and therefore that is going to have a big impact on the time and staff to audit the group. And I'll have to be careful planning the audit of Canary, because a lot of the mistakes that could happen in Canary's accounts will also be material at group level, given Canary is clearly a fairly big percentage of the group. Now obviously I'm looking at the numbers and assessing materiality. On exam day I'd be calculating them as well, and that slows me down. And one of the issues with this question is there's so many things to do and so many issues in the story and quite a few numbers flying about, you've got to do the calculations pretty quickly. Back to the question. The forecast consolidated 550 million of assets. Sorry, I've already looked at that. That's all fine, but there is more. Good, I want more risks of material misstatement, please. Starling received a grant. Ooh, grants. I know all about grants. 1st of March 2012 is during the accounting year. What is today's date? It is June. The year ends July. So about 3 months ago, they got a grant. So I'm thinking accounting standard number 20. And I'm not the only person thinking that, as I can see. And I think grants, well, there are two real things with grants that are issues. They are meant to put the money into deferred income and then release it to match versus the costs that the grant is for. And secondly, with grants, I'm always a bit nervous that they might have to repay some of it for some reason. The first one we can always put in as a risk because they might have stuck it straight into revenue. The second one, we need to see something in the story indicating there might be a need for them to repay it. So let's see. A grant of 35 million, or we can assess, of course, the materiality of that, in relation to redevelopment of its main manufacturing site. Government is providing grants to companies for capital expenditure on environmentally friendly assets. Starling has spent 25 million of it on solar panels. Well, they sound like they're probably environmentally friendly. And intends to spend the remaining 10 million on upgrading its production and packaging lines. Well, two things I'm thinking there. If they received this money already 3 months ago and they've not spent some of it yet, there might be a condition saying you're expected to spend this money quickly, because otherwise companies could get grants, just stick the money straight into a high interest bank account and just use it to generate interest. So there's one thing. And the other thing is, upgrading its production and packaging, there's no mention of how this would be environmentally friendly. So there is a risk that the way they spend that 10 million would not meet the terms and conditions, meaning they might be expected to repay it. So back to my answer I go. This is nothing to do with the acquisition, but in both Starling's accounts, because they've got the grant, and the consolidated financial statements, because it would be consolidated in, there are two risks with the grant. Revenue will be overstated if the 35 million is put in there, because it should be deferred income. And secondly, provisions would be understated if there is a need to repay it. Why? Because they've not spent some of it yet, and that might be breaching the terms and conditions. And secondly, will the upgrade of their packaging, repackaging line, or whatever it's called, will the upgrade be green, environmentally friendly? So grants are always nice because those should be two separate risks. Now we're starting to build up some decent risks here. We've got grants times 2, loans times 3, which gets us up to 5, goodwill, contingent consideration, and also impairment, which gets us up to 7. Different year end we've had, which gets us up to 8. We've got a new subsidiary, which is a mid-year acquisition. That's complicated. That gets us to 9, and their directors know nothing about group accounting. 10. And I've not mentioned everything in the answer. Those are just the ones I can remember so far. And there's something else I'll be doing at the end of this as well, which should get me some additional ideas. Back we go to the question. We've almost got to the end. On the 1st of January, so during the year, a new IT system was introduced to Crowe and Starling with the aim of improving financial reporting controls. Well, I see new IT systems and I think risk of misstatement. Not to one number, but to all numbers. So, new IT system during the year creates two risks. One, does it work? Anyone who's ever put a new computer in will know it sometimes has teething troubles, and if it doesn't, it could impact on the whole financial statements. And the second issue is they will have had to transfer the data from the old system onto the new. And it might have gone wrong. In fact, I'm now thinking there's a third risk. Because there's a pretty strong chance, isn't there, that Canary, the new subsidiary, is not using the same accounting software that these two guys are using, and consolidating with two different accounting systems is going to be a pain. So if Canary has a different system, that would make it harder to consolidate. Fantastic. The risks are picking up and picking up. Back we go again. Almost finished. Unfortunately, Starling's finance director left the company last week. Well, no finance director just as the year end's coming up and a consolidation. Surely that's another risk to Starling's accounts. So, in both Starling and the consolidated financial statements are at risk, because if there's no FD, there will be a lack of control over Starling's financial statements and any consolidation adjustments relating to that company. Now, we've not quite finished the exercise yet. I have got a lot of risks to misstatement in there. It's now looking pretty good. There are loads. But there's one more little exercise I'm going to do. And also we need to go back to the implications of the acquisition, because some of the more general ones that don't relate specifically to this story any more than any other acquisition, but which are still valid because they're implications, I just didn't see them in the story, need to go in there. Let's do part one first. We've got a pretty good answer, but we just need to add a bit more. We've done different year-end, mid-year acquisition, we've talked about materiality, goodwill, online sales. We should also say that since we are the auditor of Canary, we will need to spend some time, as I said earlier, documenting their controls and understanding the entity. And since it is a new client, we did not audit their opening balances, did we? No, we didn't. This is an initial audit, to use auditing terminology. So we'll also need to spend some time checking the opening balances are okay. Whew. Now, in terms of risks of misstatement, I think I've probably got enough there. But often, in a question like that, where it's a big story and you've just got to plough through it looking for them, sometimes we don't spot enough. So here is a little tactic that I like to use, just to make sure I've considered everything. I can do this in the space of about 30 to 45 seconds. A minute tops. You're likely to take a bit longer. But on the other hand, when I do this, as you're about to see, I'll hit a lot of stuff and you might not hit quite so much, so that speeds it up. This is what I would do. I think I've said before, I think it's a great idea if you do know the accounting rules and the numbers of the standards. Because if you are looking for risks of material misstatement, one way of looking for them is to do this. IAS 1, main thing in IAS 1 is disclosure of accounting policies. I've mentioned the online sales. Also, it's about threats to going concern. To be honest, I didn't see any obvious threats to going concern in there. So no. IAS 2, inventory. Well, they've got inventory, but I can't see any obvious risk. There's a problem with it. 3, no, 4, 5, 6, 7, cash flow statements, nothing exciting there. 8, prior period adjustments, nothing obvious. 10, events after the reporting period, the accounting year hasn't finished yet, so how can there be any of those? 11, construction contracts, irrelevant. 12, deferred tax, got one. Because whenever there's a new acquisition to a group, the new acquisition will bring its own tax history in, and that can change the group's deferred tax position. So the group deferred tax, so this is the consolidated financial statements, might change with the acquisition. If you think about it, capital allowances versus depreciation, if you add in Canary's capital allowances and depreciation, it could change the whole balance. 13, 14, 15, property, plant and equipment, nothing obvious. Leases, can't see any in the story. 18, revenue, we've already mentioned it. 17, 18, 19, employee benefits, can't see any pension schemes in here. 20 is grants, we've already dealt with it. 21, foreign exchange, no mention of imports, exports, nah. 22 doesn't exist. 23, borrowing costs. Well, we've dealt with the loan and the interest. The main issue for us on this exam with borrowing costs is capitalising any interest used for loans that are financing construction of an asset, but that's not in the story, ignore it. 24, related party transactions, there's another one. Because the new acquisition will have its own related parties, there is a risk of under-disclosure of related party transactions in the consolidated financial statements, because Canary brings new related party relationships to the group. IAS 24. Let's write IAS 12 up there. And I would never have thought of those if I wasn't cycling through like this. Nothing else in the IAS 20s, 30s, 33 earnings per share, no. 34 interim accounts, no. Impairment, can't see any falling sales. 37 provisions, nothing in the story suggesting provisions. Intangible assets, nothing suggesting any issues there. 40 investment properties, no. 41 agriculture, did you see any pigs in the story? Neither did I. IFRS 1, first time adoption of international accounting standards, no. Share-based payment, no. Goodwill, yes, we've dealt with it. 4 is not on the syllabus. 5, assets held for sale and discontinued operations, nah. 6, not on the syllabus. 7, disclosure relating to financial assets and financial liabilities. In other words, financial instruments. Yes, there's a loan, but we've dealt with it. IFRS 8, operating segments. If there's a new acquisition, it might qualify as a new segment of the business, and therefore they might under-disclose their segmental information this year if they don't adjust it to take account of the new acquisition. Now, whether it is a new segment or not, I'm not sure. I mean, it sounds like it makes pretty similar stuff to the rest of the group. I don't think it's overseas, but hey, let's go for it. Under disclosure of segmental information, IFRS 8, if the new acquisition changes the segmental split of the company. If that's what it does. It's not that impressive, to be honest. It's actually quite sad that I know all this stuff, I think. IFRS 9, financial instruments. Well, yes, that's the loan, financial liability. Can't see anything else in there that's financial instruments. IFRS 10 is consolidation. And that is the issues like different accounting policies, year ends. Well, we've dealt with that. IFRS 11 is joint arrangements, sorry. So things like joint ventures. There's no joint ventures in here. What's 12? 12 is disclosure of interests in all other entities. They've just bought a new acquisition. They have to disclose their interest in that acquisition, why they bought it, how it fits into the risk profile of the company. Being new, they might forget to do it. Yay! Under disclosure of interests in other companies, IFRS 12, if they forget to disclose canary. You don't just consolidate, you tell the shareholders what you've bought, why you've bought it, how it fits, etc. And finally, IFRS 13, which is fair value. There's fair value in the goodwill, but that's dealt with under goodwill. I could not see anything else in here where fair value was an issue. Is this practical under exam conditions? Well, bear in mind, that took longer than it should have done because I was reading it out loud rather than just thinking it. And secondly, interesting question, my friend. What is impractical about spending 2 minutes and coming up with 4 separate risks that I otherwise would not have remembered? Because I genuinely wouldn't have done. I've just got myself potentially another 4, 5 or 6 marks depending on the quality of my explanations. And I would suggest that if you can score 4 marks in about 2 minutes, you're scoring 120 marks in an hour, which means you'll score 360% on this exam. I would say that's not just practical, I would say that's rather essential, wouldn't you? Now, you won't spot as many of them, but equally, if you don't know all the accounting standards, you won't ask every single question, will you? So it will be quicker. If I was doing that without explaining it, I would just cycle through it very, very quickly. Trust me, it's a great idea on the exam. I say it's a great idea. It works very well with this style of story where it's just go and find me lots of risks and the story is big. It's a nice way to do it. If it simply says, you remember the other question, issue 1 and issue 2, there was no point really doing it because it was very clear that issue 1 was worth a certain number of marks and it was clearly IAS 11 and issue 2 was clearly IFRS 5. But if you're looking for lots in a big story, this is quite a decent idea. If you want to get good at this, I know all the audit standards, I know all the accounting standards. How did I learn them? Because you've only got 3.5 weeks till the exam. I'll tell you how I do this. This is really sad. But at home I have a treadmill because I like to run. But my knees aren't great because I used to run a lot when I was younger and my knees are a bit wrecked. And I can't run on the roads. So instead my treadmill is softer balance, so it's easier to run on it. But running on a treadmill is so boring because you don't go anywhere and it's in my garage, so there's nothing to look at. So when I'm running, this is what I do. Every 8 steps I go IAS 1, threats to going concern, IAS 2, inventory, lower of cost net realizable value. And I just go through all the accounting standards and the key rules in my head. And when I've finished those, I do the audit standards. And when I've done those, I recite all 193 members of the United Nations and their capital cities, and all 42 American presidents, and every American state and every American state capital. And by that point, I'm usually so tired, I stop. And that's what I do, and that gets me through about 7 kilometers of running. It's true. So it's a bit boring and a bit... but you know what? It works! Anyway, you get my point. There's no need to spend ages doing that. But if one of those questions comes up, just cycling through the numbers makes a lot of sense. Okay, I'm glad it impresses you. Right, well, we've got ourselves an answer now. I wrote the entire answer for the third bit. The other two, I've shown you how to come up with the ideas. For group issues, remember the list of issues to look out for. With this one, it was not an overseas sub, and there was no other audit firm, which held us back a bit. But we did have different year ends, maybe different accounting policy. It's clearly material and it's mid-year. So there's enough in there to pass it. With risks of material misstatement, most of them are talking about one thing in the accounts being wrong. Don't forget control risks though. No finance director could mean all of Starling's accounts are wrong. New IT systems could mean all of the accounts are wrong. And then it just comes to practicing explaining them. Okay, I think we are due a break. So it is 1934, according to the clock here. So we'll take 15 minutes, because I think we need a bit of a rest, and we will restart at 1949, when we are going to move on and look at something else. See you in 15 minutes, my friends. Okay, well, 15 minutes up. Hopefully everyone's feeling a little bit refreshed. And we move onwards. Okay, what we need to do now is move on and start looking at some audit reports. What we're going to do is this. We're going to have a quick reminder about the audit report knowledge we need. We're then going to move away from audit reports, and then we're going to move back again. Just to give you a little bit of time to let the memories seep back in again, but also because if I just do the knowledge and then do a question, I find we tend to have a bit of a problem, which is that the question seems easy because I've just told you what all the answers are. Okay, so what we're going to do, quick reminder of the knowledge. First thing is you need to know what an audit report looks like, what goes into it. Now, most of the sections at the top of an audit report, frankly, are fairly boring and not much use for the exam, because the stuff at the top, not the introduction, sorry, no. The title, the addressee, the intro, and the responsibilities are standard wording. And therefore not very exciting for the examiner. Not very examinable. Then we get down to the rather more interesting bits, because once we get past that, we get basis of opinion and opinion. With the basis of opinion, if the opinion is modified, the explanation goes in the basis section just above the opinion. Now we'll be reminding ourselves about modifications shortly. Remember, you can have except for, and there's two separate reasons we get except for. You can have adverse, you can have disclaimer. All of those are changing from the normal opinion that says true and fair. So any of those get explained above. We then have the opinion. Whether the financial statements are true and fair. And then possibly we get an emphasis of matter paragraph or an other matter paragraph. But these are only if they are needed. So they're not normally there. So those are the contents of an audit report. It's the stuff currently there on the screen that you need to make sure you're happy with. If the opinion's being modified, you explain above. If we need one of those extra paragraphs, they go below. Which means we now need to talk about those modifications and those extra paragraphs. So we've got 7 possible outcomes to an audit report. Quick reminder. The first question we have to ask ourselves as auditors in order to form our conclusions is, did we get sufficient evidence? If the answer to that question is yes, we'll go to question number 2. But if the answer to that is no, we then get our first 2 outcomes. Because if the lack of evidence is material, then we will have a qualified opinion using the words except for. If, however, we believe the lack of evidence is pervasive, then we will have a disclaimer of opinion, meaning we will say the we cannot or do not form an opinion. So there's two of our outcomes. If we did get sufficient evidence, off we go to question number 2. Where we ask the question, are the financial statements wrong? If the answer to that is no, we'll go to question 3. If the answer to this is yes, well, we have a similar analysis to what we saw with the evidence. Because if the misstatement is material, we will have a qualified opinion except for. If, on the other hand, our misstatement is adverse, pervasive, then we will have an adverse opinion, meaning we will say the accounts do not give a true and fair view. And there we have got our 4 modifications to the opinion. Except for, disclaimer, except for, adverse. Just before we go on to question number 3, an important note. If the problem, be it a lack of evidence or a misstatement in the accounts, if the problem relates to a small number of items in the accounts, then we tend to say it is material. Don't forget, numerically, we normally start saying material at 5% of profit. So 5% of profit only affects maybe 1 or 2 items. We go for except for. If, on the other hand, the problem relates to most items in the financial statements, that's what we mean by pervasive. Now, of course, the words small and most are matters of judgment, and there will be some point in the middle where you're thinking, well, I was going to say material, but now I'm thinking pervasive, and it could go either way. If you're not sure in an exam question, argue it could be either. Because auditors have to make this call on a regular basis. And one audit firm might look at it and say, well, there's 5 mistakes, but I can say except for that, and that. And other audit firms would say, no, 5 mistakes, too much, adverse. It's subjective. Examples. Okay. Material misstatements leading to an except for. Depreciation's wrong. Bad debts are wrong. They've done revaluations wrong. They've done deferred tax wrong. They've done any of those. Any individual mistake. For it to be pervasive misstatement, we are normally talking about something which affects most of the figures in the accounts. For example, let's imagine they've got a massive subsidiary which is 60% of the group and it's overseas. But when they did the retranslation with foreign exchange, they used the wrong exchange rate all the way through. Well, that means the consolidated accounts are going to be wrong all the way through. That's probably adverse. The main one is where the company thinks they're a going concern, but the auditors disagree with that, because that means you are disagreeing with the entire basis of preparation of the accounts. Adverse. In terms of lack of evidence, if you turn up to the client and a computer virus has wiped out all of their accounting records, how can you do the audit? If you turn up to a client and the client says, we've got some very sensitive stuff going on here at the moment, therefore I'm not going to let you see quite a lot of the evidence. Well, that's pervasive, isn't it? You can't do the audit properly. Pervasive is relatively rare, both in the real world and in the exam world, because there aren't that many situations that would lead to it. Whereas except for, how many accounting standards are there? Any of those could be wrong, so there are millions of examples of except for. Now, we haven't got to the end yet, because all I've looked at are the 4 modifications to the opinion. Let's now continue with this. We need to go to question number 3. Now, if you've got as far as question number 3, that's quite all right. If you've got as far as question 3, we can already conclude something. If we've got all the evidence and the accounts are not materially misstated, it must mean that the opinion will not be modified. If you've got to question 3 in your analysis, the opinion is not affected. But now the question we have to ask is this: is there something very significant in the financial statement disclosure notes, e.g. a going concern threat, which has been correctly disclosed? If it was not correctly disclosed, that's a misstatement. And we go back to question 2 and deal with it there. But for something really significant, even if they've correctly disclosed it, if the answer is no, we're going to go to question 4. If the answer is yes, there is something significant, but the company has correctly disclosed it as they should have done, we are going to add an emphasis of matter paragraph. And remember, that goes under the opinion. And then question number 4, the final question we have to ask. What have we concluded so far? We've got all the evidence, yes. The accounts have no mistakes, yes. So the opinion is not modified. There's nothing we want to emphasize. So the last question we have to ask is therefore, is there anything in the other information? Remember, that is the unaudited stuff in the annual report of the company, which is inconsistent with the financial statements. Because if the answer to that question is yes, there is, we need to add an other matter paragraph under the opinion. And if you get all this way through and the answer to the question is nope, then our conclusion is you've got all the evidence, the accounts are true and fair, there's nothing to emphasize and there's nothing wrong in the other information. Well, that's it. So the answer now is a standard unmodified report. So not only is the opinion unmodified, everything's unmodified. There's nothing to change. Okay then, fantastico. Well, that is what you need to know. And what you'd probably love me to do now is an audit report question, but we're not going to do that. We're going to do the audit report question a bit later. Instead, having filled your head with audit report stuff, I'm now going to give you a few minutes for it to disappear out. And instead, we are going to do a different type of question. We are going to do something we've seen in the risk question, so we've had a bit of practice of this already, but we're going to take a look at matters and evidence. Can we use the term unqualified? Yes, you can. But it is not the same as unmodified. There's qualified, there's qualified. Any other outcome is not a qualification. Adverse is not a qualification. Disclaimer is not a qualification. Qualify and modify are not the same. If it says except for, it's qualified. But to modify means to change anything. You could modify by issuing a qualified opinion, an adverse opinion, a disclaimer of opinion, and all of those are modifying the opinion. You can modify the report by modifying the opinion, or by adding either of those extra 2 paragraphs. You see my point? Modify means change. Qualify means using the words except for. It's a lot more restricted. Be careful with that. A lot of people mix up the words qualify and modify. Not the same thing. Okay, so matters and evidence. We've come across this already on our course as we've been doing some revision. Let me just remind you that if you see a question that says something like that, for our matters, we should be thinking, what are the relevant accounting rules for the situation? If we can tell, has the client got it right? And we should assess, oh dear, not like that. We should assess the materiality of the situation. If our client has definitely got it materially wrong, so you can tell from the story they've definitely got it wrong and it's definitely material, then I would also mention that the audit opinion will need to be modified. It might be modified with a qualification, but if they've got it really wrong, it might be adverse. And then when it comes to the evidence, whoops, we can use A, E, I, O, U, we can think DADA 3, but as I've tried to persuade you, and I think this one probably works best, test every fact, date, event in the story. Anything she tells you, test it. The only other thing you need to know to be good at these is every accounting rule, every accounting standard, which is easier said than done, isn't it? But don't forget, you can get relatively easy marks by focusing on materiality calculations and the evidence, because the evidence tends to be the easy bit. What is DADA 3? I do not remember. Well, you better start remembering, my friend, because the examiner The examiner? What am I talking about? The exam is 24 days away. Yeah, it's getting close. So, Dada 3 are the 5 types of audit evidence. Useful list to help us remember what we should be doing. Don't worry, who cares if you don't remember it today? As long as you know it on December the 1st, everything's good. So, we can audit by inspecting documents. We sometimes inspect assets. We sometimes ask people inside the company, like the directors. Although, of course, we'd rather ask people who are more independent outside the company, third parties. And sometimes our audit tests involve us verifying things are in the accounting system. So, for example, checking the inventory is on the inventory list. Checking an asset is in the asset register. Checking the cash book, sales day book, purchase day book, etc. Okay then. So, matters and evidence questions. Yes, your accounting knowledge is important, but there are easier marks to be had. Let me show you what I mean with an example. Now, with the matters and evidence questions, there are going to be accounting issues in there. There is not much point doing the more recent questions because with so many accounting standards she could set, it's better to go back a few years and look at older questions because the accounting standards will come round and round again in a sort of cycle. So having looked at what might come up on your exam and recent papers, the one I would like us to have a look at is December 2008, 6 years ago, question number 3. Now I say that and immediately think I'm lying to you because actually I think it's not December 2008. I think it's December 2010. Let's go and have a look. Is this it? December 2010? Let's have a look. 1, 2, 3. Yep, it's December 10. Sorry, my mistake. So this is December 2010, so 4 years ago. I thought December 08 felt a bit old. 4 years, sensible time. I would do as many questions as you can from December 10, June 11, December 11, June 12. Because that sort of 2 to 4 years ago is where you're likely to get rather more repetition coming up on your paper. And you can't do all the questions, can you? Okay. As always, I don't read the story. Story coming up soon. Let's go look at the requirements. Comment on the matters you should consider and state the evidence you should expect to find in your review of the audit working papers for the year ended September 10. We're in December, don't forget, so we're 2 and a bit months after the year end. And we've got 3 stories. A compensation claim, Shelley's Cruises, and oh look, groups, we've got an acquisition. Well, can't tell too much from that, although compensation claims suggests what, IAS 37? Provisions, contingencies? Shelley's Cruises, who knows, could be anything. Acquisition of Craig. Is this going to be the same as the question we just did? If so, 5 marks doesn't look huge. I mean, an acquisition could be a huge number of things. Who knows? Let's stop second guessing. Let's go read our story. Clooney is a leisure travel provider, operates under several brand names to sell package holidays. 10 million customers in the last year. Draft figures for the year ended 30th of September show revenue of $3,200 million. Wow. Profit before tax of 150. Total assets of 4,100 million. And that, of course, is there to help us assess materiality. Clooney's executives earn a bonus based on the profit before tax. Now, I hope it's fairly obvious that if you're told something specific like that, it's got to be relevant. And if they get a bonus based on profit, what does that mean? It means that when you're looking at matters to consider, there is already in my mind a risk that they will try to overstate revenues and try to understate anything to do with costs. Because, as you correctly say, they have a clear reason to be biased, to manipulate the accounts, to window dress, to cheat, in other words, because it would improve their bonus. You are the manager responsible for the audit of Clooney. The final audit is nearing completion. And the following points have been noted by the audit senior for your attention. So the idea is your audit team have gone off and done the audit work. They've come back and the audit senior is handing over the audit work done. And these are 3 things that he's not sure about. So he's letting you know that they're there so that you can take a look at them. Right, here we go then. First story. In July 2010, it's a date. Whenever you see a date, stop, think. The year end is September. It is currently December, because that's when this paper came up. So one way of looking at this then is 5 months ago, thousands of holidaymakers were left stranded abroad after the company operating the main airline went into liquidation. Holidaymakers forced to wait an average of 2 weeks before they returned using an alternative airline. I see that as 2 weeks extra holiday. They formed a group claiming compensation for the time they were forced to spend abroad. Total of 20 million. Items which the group are claiming: accommodation, subsistence, lost income, distress. The claim has not been recognised or disclosed in the draft financial statements, as management argues that the full amount payable will be covered by their insurance. So management are not suggesting they won't have to pay. They're suggesting that after they pay, their insurance company will pay back all the money they have to pay. Interesting argument. So I think what I'm reading from that is they're expecting that they'll have to pay something, maybe all of it, but they'll get it back via insurance, and that's their argument for not claiming. Okay, armed with all of that interesting information, let's start planning ourselves an answer. As always, follow the technique. We start off by thinking, what are the relevant accounting rules? Well, if there's a claim against the company, we should surely be thinking IAS 37. And IAS 37 says, if there is a year-end obligation, and that obligation can be created by legal matters or constructive, and some sort of payment appears likely or probable, in other words, and it can be estimated, that would require a provision in the financial statements. So let's start with that. Do we think that an obligation exists to pay this? Well, I would have thought if I go on holiday and I buy a return ticket and you are unable to return me because the airline your company is using has gone bust, I think you probably owe me some money because you are breaching my contract. And even if there's no legal obligation, if whenever people have been stranded abroad in the past, you've always paid, or if I've phoned you up from overseas and said, what's going on, I'm stuck, and your staff have told me on the phone, don't worry about it, you are entitled to some compensation, let's get you home first and then we'll sort it out. If they're making promises over the phone, it's a constructive obligation. So if holiday terms and conditions have been breached, then it's a legal obligation. Alternatively, if the company's staff have promised compensation, it's a bit like announcing a redundancy, isn't it? You could always change your mind, but according to the accounting standards, a promise is constructive. And even looking at all of that, the words of the directors saying we've not provided for this because our insurance will cover it suggest to me that the directors sound like they know, they'll have to pay. Their argument says to me they know. So I reckon they need a provision then. Now what's their argument? We don't need a provision because insurance will cover it. Sorry, there's an obligation. You need a provision. The insurance is a totally separate matter. The compensation is between the company and its customers. The insurance is between the company and its insurance company. You can't net off two things between two different groups of people. Not going to work. So as far as the insurance, if any claim is deemed highly likely to happen, they should be disclosing it as a contingent asset. You can't net off a disclosure note because it's not an accounting entry. It would only be an asset if virtually certain to be received. And even then, you don't net it off. You have the obligation in provisions and you have the asset from the insurance company. So however we look at this, they're wrong. So set out the rules. Stage 2, state the client has got this wrong. Stage 3, materiality. Well, their profit for the year is 150 million, and 20 million over 150 million is 10% would be 15, 10 and a third, so it's 13.3, 3% of PBT, and that's material. Since provisions go on the statement of financial position, I suppose we could also say 20 million, what were the assets? 4,100? Ooh, that's just under 2%. What's that, about 1.9% of assets equals just becoming material. Hang on. 410, 41 is 1%. No, that's rubbish. Rubbish, rubbish, rubbish. My maths are all wrong. Being naughty and not using a calculator. 41 million would be 1%, wouldn't it? That's 0.5% of assets and therefore not material to the statement of financial position. But as long as it's material to something, which it is, it needs adjustment. And because it's material and they've got it wrong, well, it's only one mistake in their accounts. I think they're going to get an except for qualified opinion, aren't they? It's material, but it doesn't affect many things in the accounts, and those would be the matters I would be suggesting. Now, if you're comfortable with your accounting rules, that's not too difficult. If you're not, calculating materiality is an easy mark. And for the evidence, test everything we saw in the story. What did it say? It said in July they stranded lots of holidaymakers. So test it then. How do you know that in July this company stranded lots of holidaymakers? Answer? Wouldn't this have got into the newspapers? Major holiday company stranding everyone abroad? I think it probably would have been. So I'd be tempted to check that on file we have copies of press reports to verify the event happened. And remember, we're testing what it says in the story. It says this happened in July, so check it happened in July. And in July. Now you should get a mark for writing that. That should be enough to persuade the markers. If you want to go a little bit further and just prove you know why you're getting that evidence, it's to prove an obligation seems to have happened before the year end. It's actually the date that you're really checking here. Is it legal or is it constructive? We'll come back to that in a minute. What else does it say? It says that these poor people are claiming 20 million. So I would like to see on file a copy of the $20 million claim to confirm claim exists and the amount. Notice I'm always explaining why. They also say that they're not providing for this because their insurance will cover it. So prove it then. I would like to see on the file a copy of the insurance policy to verify it looks like any compensation will be covered. Read the insurance policy. So simply by testing the details in the story and not trying to get clever about anything, just test what it says, I have got myself 3 bits of evidence. Now I think this was worth 8, wasn't it? Where is it? Where is it? Second from bottom, remember that. This one is worth 8 marks. If it's worth 8, I'm looking for roughly 4 matters, 4 evidence. Just by testing the story, I've got 3 bits of evidence, calculate materiality, 4 out of 8, without ever mentioning a debit or credit. You don't need the accounting knowledge to pass these questions. For material misstatement, oh yes you do, but for this question, you can actually get around it. Now other tests that I would do, questions, sorry. Could that be 2 bits of evidence, one for the date and one for the event happening? I don't think so. I mean, the evidence is the claim, isn't it? The evidence is the copy of the press report. So it's one piece of evidence that's telling you 2 things. So no, you need separate bits of evidence, I'm afraid. 8 marks, will a page be enough? I've no idea. 8 marks, write 8 things. If you can fit 8 things on a page and explain all of them, yes. If you need 2 pages to write 8 things, 2 pages is enough. It's not about length, it's about the number of separate points you are making. Other things I could do, we need to know if they're actually guilty of this. Will they pay anything? Various things, if I now think, stop checking the details now, I'm sort of thinking AEIOU, DADA3, E, inquiry, let's start at the beginning, sorry. A, analytical, compare. If they've ever had problems in the past and always paid compensation, their history of always compensating would make this a constructive obligation. So you would get a mark if you said an analysis, so analytical, of any past events similar to this, because if they always pay compensation, you could argue a constructive obligation exists. Of course, I said a constructive obligation also exists if this company's staff have already said to the people who got stuck, and don't forget they got stuck 5 months ago, there must have been some communication, I'd have thought. If we can see on the file copies of correspondence with customers promising compensation, that would be a constructive obligation too. Or maybe it's a legal obligation because they breached the terms and conditions of the deal. Now, if we're talking legal, you could read the terms and conditions of these holidaymakers. I'd be tempted to ask their legal department because they've already read them. In fact, they probably wrote them, and they'll have a better idea of how much legal coverage there is. Is that specifically that company or the industry? That company. What you're looking for here is a company that always tends to do the same thing. If other companies pay, it doesn't mean these guys will. If other companies always pay, it is some evidence. But what you want to see is the character of this company. If they always pay in these situations, they'll pay again this time. So I might also get legal opinion from the company's lawyers of the likelihood of a payout. Now, I've easily got enough to get full marks on this. You could also argue that given that the customers got stuck 5 months ago, it's now December, don't forget, might they already have started making payments to some people? In which case, looking at the cash book and bank statements after the year end to see if they've already started paying. They might have done. And if you start paying to some people, I'd say that's a constructive obligation, because if you're paying to some people who got stuck, you're going to be paying to all people who got stuck. But we've already got enough. Way too much, look. Way too many bits of evidence. So let's move on and look at the second one. Shelley's Cruises, 7 marks. Almost the same, so similar approach in terms of the number of points we need. One part of the company's activities operating under the Shelley Cruises brand. Aha! Is this going to be about brand names then? IAS 38 provides cruise holidays. Due to economic recession, the revenue of the Shelley's Cruises business segment has fallen, and if you ever see those words, revenue is falling, you should be thinking impairment. The assets of the Shelley Cruises business segment would appear to be impaired. And when we impair, the first thing we impair are intangibles, starting with that brand. It's fallen by 25% this year, the revenue, and profit is down by 35%. Shelley's Cruises contributed $640 million to total revenue, which means we can now work out what sort of fall in revenue this is in numerical terms. And it's told you the size of the assets, which means we can work out how much of an impairment maybe has occurred. The Shelley's Cruises brand is not recognised as an intangible asset, as it has been internally generated. So we won't be impairing the brand then, because the brand is worth 0 in the accounts. It doesn't exist. Well, after the brand, you just start impairing all the other assets, the tangible ones, including, it would seem, those 2 large cruise liners, because the value of those cruise liners is in terms of the number of people who buy cruises. The value of any asset, the net present value of the returns it generates. So, what would I say in terms of the second one? Again, we start with accounting issues, and this is IAS 36. Because any fall in revenue suggests that the assets of that division, or that cash generating unit as it's called in IAS 36, might be impaired. Right, well that's the issue then, it's impairment. Has the company got it right? I've got no idea, because it doesn't say in the question whether they've done an impairment review and whether they've written down the value of the assets. So say so. We cannot tell if a year-end impairment review was done or if asset values were written down. They might have done this already. I don't know. Cannot tell. We then move on, as always, to materiality. Now, materiality in this question needs a little bit of thought. The key issue here, is this division material? Is an impairment of this division material? Let's go back and look at the numbers. Well, Shelley's Cruises contributed 640 million to total revenue, and the company's total revenue was 3,200, and 640 over 3,200 is exactly 20% by the looks of it. It also says, well, I don't know, what do you want to do? 25% of revenue, 35% of profit. I guess you could take either of those numbers. Let's take 25% because dividing by 4 is so much easier. The assets are 235. So if 235 needs to be impaired by a quarter, 25%, which is one argument you might say, that would be a drop of about 60 million. This company's made profits of 150 million. You might be about to knock 60 out of 150. That's 40% of profit. So the division is 20% of revenue, which is material. And if assets are overstated by 25%, that's the fall in revenue I'm using as an estimate of how much of an impairment there might have been. Well, 25% of 235 million is roughly 60, in fact I think it's 59 million, and that is 40% of PBT, and that is very material. Now, I remember back at this point to the beginning of the question where it said the directors get a profit-related bonus. And I'm thinking I've not mentioned that yet. So maybe, having completely forgotten about it, I should go back to the first bit of the question and say one of the matters I am considering is that the reason they've probably left this provision out is to protect their profit-related bonus. And that is relevant because I'm considering that matter, thinking that's probably the real reason they're leaving it out. In other words, I think they do realise they should have a provision and disclose a contingent asset, but they're trying to protect their bonuses. Likewise, in the second one, have they done an impairment or not? Well, I cannot tell, but I'm guessing probably not, to protect their bonuses. Now, I don't know if they've got it wrong, so I can't say audit opinion because I don't know. So I would now move on and look at the evidence. And again, I would test the story. What does it tell me? It tells me that profit is down by 35% and revenue is down by 25%. So to verify the fall in PBT and the fall in revenue, what would I want to see on file? A comparison of the 2010 results with 2009. It also says that there is no brand associated with this division because it was internally generated. So I suppose I should see on the file an analysis of intangible assets to verify no brand names was acquired. Because if it was acquired, it would have been capitalized. Now this one is a bit more difficult because after that the story doesn't really tell you anything. So now you've got to think a bit more. And I'm thinking, I know their results have come down up until 30th of September, but it's now early December, so I'd also like to see the results of this division for October and November 2010, so post-year end, to see if the impairment is temporary. In other words, have revenues started to rise again. After all, the value of something is looking into the future, so in fact I'd also like to see a copy of the division's forecasts to see if revenue is expected to rise. But given we know that the people who did the forecasts are the ones getting the profit related bonus, I would need to review the assumptions very skeptically because of the bonus. Other things you could do, well, how about looking at travel magazines? Because industry magazines should give you some indication of whether the industry is picking up, if it's still really suffering because of the recession. So why not take a look at those? Now we're almost out of time tonight, and I would like to quickly look at the last one. So let's go and take a look at that. Only 5 marks for the last one, and only 2 lines of information. So for the last one, C, let's just plan it up here, and let's take the exam technique approach. Let's start with the evidence, not the matters. Let's just test the story. On the 15th of November 2010, Clooney acquired Craig, a company. Okay, how do you know they acquired it on the 15th of November 2010? I'd like to see a copy of the purchase agreement to verify the date and amount of the acquisition. 1 mark, we're aiming for 5. Craig represents a significant acquisition. Well, significant means big, so wouldn't we want to see a copy of, I don't know, Craig's financial statements to assess the size of the company? As it says, it is significant. If it's worth 5 marks, it may well be 3 matters and 2 evidence is enough, so we may already be there. So let's move on to the matters. The question said, on the 15th of November 2010, that is after the 30th of September year end, which means this acquisition is an event after the reporting period, IAS 10, and therefore could be adjusting or disclosable. It's adjusting if it gives you more information about the situation at the year end. So it's not adjusting. They didn't have an acquisition at the year end. Post-year end acquisitions are not adjusting because that subsidiary did not exist on the 30th of September. So say so. I'd say it's non-adjusting because the sub was not owned as at September the 30th. So the question now is, would a significant acquisition of another company after a year end be something that a company should disclose? Well, IAS 10 says disclose significant events after the reporting period. The question says it's significant. Therefore, it should be disclosed in a note to the financial statements. Materiality, the question says significant, so it appears to be material. The only thing I've not done, I've said the rules, I've said materiality, I've not said if they've got it right, because I've not read everything yet. Acquired Craig. Craig represents a significant acquisition, but this has not been referred to in the financial statements, which means the client is wrong and materially wrong, and therefore my audit opinion will be qualified except for. Turn that into sentences and hooray, we've got ourselves an answer. So there's no numbers in this, I can't do materiality with calculations, but you see my point there, the evidence is not that difficult, just test the facts in the story. If you know your IAS 10, C is easy. If you don't know your IAS 10, start with the evidence. Right, we've had a busy evening. We've done a monster of a question that's got groups in it, loads of risks of material misstatement, and we've done some audit procedures, and we've done matters and evidence, and we've revised audit reports, which means with one class left, we can now focus on some audit report practicing questions and some non-audit assignment questions, and 1 or 2 other little bits and pieces to fill in as well. Okay. Thank you, Claire, and I hope you have a good weekend as well. So, my friends, that is it for tonight. Hard-working night, some good questions and some technical stuff covered as well. Thank you all very much for giving up your Friday nights. It's horrible doing this on Fridays, isn't it? But we have no choice. Can't squeeze all the papers in otherwise. Thank you. And I will see you guys next week for one final class and one final batch of questions. See you guys. Enjoy your weekend. Work hard.